What will the inflation reading today tell us? Should we be worried about China lockdowns and protests? And what are the two big data drops ahead for stocks this week? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Well, Paul, monthly inflation reads, we're not used to it, but they're becoming something economists are watching.
They are, and there's a big variation in terms of estimates for today, which I think tells you something about monthly inflation, Peter.
Yeah.
But
there's no history, so reliable forecasts are hard to believe.
Yeah, and it doesn't cover all the CPI. It covers, I understand, about 70% of the CPI. I think that's about the number.
Yeah.
So look, there's some big numbers out today. Some saying that the annual rate will be largely unchanged. Others saying it could go up by 0.5%. So I'm not sure, unless it's on the high side. I don't think it means much for our market, but you never know, Peter. It's markets showing a little bit of strength, and people seem to be a bit more comfortable. And I thought yesterday's performance in the Aussie market was pretty strong, notwithstanding the lead from Wall Street.
Consumer confidence has been up 3 weeks in a row, which is still from low levels, but still it's showing people getting used to the high interest rate environment. But Paul, I think the point is, if this is a much bigger number than expected, and I think energy prices will be critically important for this one. I think the September one was more building costs, and they're all there. But until we see the interest rate rises from the Reserve Bank really hurting households, I think the RBA is going to look at this and say, if it's on the high side, we need more rate rises.
Yeah, I mean, I think notwithstanding what happens here and we're definitely heading for 0.25% in December.
Yeah.
And we're still a long way to go, right? Potentially compared to where everyone else has gone on interest rates. So interesting, our stock market, Peter's almost back up. If you look at year on year or for the 12 months, we're almost up. So it's...
so my 10% call earlier this year might end up being right after looking wrong for most of the year.
There are a lot of bears out there at the end of June, and there's still reading some pretty bearish headlines out there, but... for investors, it hasn't actually been too bad. If you've been in the major stocks, resources and banks, you've done pretty well.
Well, I think it's probably, we might jump a story and come back to, because there are two big data drops in the US this week, which will have a very big impact, I think, on Wall Street and then on us. And the first one comes, the Fed doesn't really believe the US CPI is as reliable as the PCE. What's PCE stand for?
Personal consumption expenditure.
I
don't know exactly what the difference is, Peter. I'm not an economist, folks. That's beyond me. But this is, I understand, the Fed's preferred measure, and
they think it's a greater reflection of the real inflation for the US consumer, and that's what they look at. And it comes out on Thursday, and the last one was better than expected. And then the CPI was better than expected. So I guess if the market sees a better than expected PCE, they'll really like it. And that rolls into the very important data drop on Friday, US time, jobs report.
Yeah, and we are. Look, you've got to start, I guess, to expect a little bit of weakness, given, you've all been reading about the layoffs in Silicon Valley. Most of the major tech companies have started to lay off people. I'm not sure, the American economy is still pretty strong, and I'm not sure this is the time for a major turnaround, but you've got to expect a little bit of softness to start to creep into those figures. It's just can't go on. But
because the tip is 200,000 jobs. That doesn't sound like a pullback, does it?
That doesn't sound like much of a pullback to me, but we are starting to see at least some mass layoffs in certain industries, and that's obviously starting to ease some of the pressure over there.
And the interesting thing, Paul, is if there's only 100,000 jobs, the market will like it for the inflation interest rate scenario, but then start stressing about, are they going into recession? So it's just going to be a very, very interesting week next week after those job numbers come out on Friday night our time. Our market won't react until the Monday. All right, let's go to the other big story that you're interested in, and you pose the question, should we worry about China lockdowns and protests?
I think you've got to watch this very carefully, because, Australia's fortune is so much tied up in China, particularly the fortune of our major miners. Yesterday we saw the Hong Kong Stock Exchange rally by about 5% on news that looks like the Chinese government, they might be going after some of the troublemakers, but they are perhaps listening to some of the feedback. And also COVID cases were down a little bit, I think was part of the story. So I still think this is a big story here. If they can, we need the Chinese economy to to be moving ahead.
Yeah,
That's
our most
re-
important trading partner.
Our most important trading partner. So this is, if you're an investor, you got to keep an eye on China. This is certainly, and you should be worried about it, folks.
Yeah.
So I'm not saying the right or wrong of any of this stuff, but from a financial point of view, what happens in China is really important to your portfolio.
Yeah, and I think when you put it all together, if we get some better news on inflation and China sort of indicates that it's not going to go hard on lockdowns, there'll be two very big positives for the stock market. But vice versa, if they say, oh no, we're still going hard on lockdowns and the inflation numbers disappointing, well, stocks will fall, and the market is 50-50 on this.
Yeah, I've always argued, Peter, that an outbreak of democracy in China, we might believe it, but for us investors, that's a bad outcome, right? Because that's not going to end nicely for anybody, right? So, I'm not making any political statement here, folks.
It sounds like it.
We want, as investors, dollars first. This is mad about money, not mad about democracy. We want a nice, orderly position in China, and we want strong growth, and that helps the market for our commodities, right?
I guess what you're really saying is you want Xi Jinping to rediscover his capitalist drive and allow China to gradually become more capitalistic, and that would be good for both Chinese people and stock market players. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.